All right, good morning, everybody. It is Friday, April the 4th, a little before 9 a.m. And Chad and I are getting on this morning just to have a quick conversation about this week's events. The markets have really been rocked since Wednesday afternoon with the announcement of some fairly substantial tariffs that the Trump administration has levied on a number of our trading partners. And so we're just going to talk about the market's response to that and some other things that are going on economically, just to give you some updates here. But the first things that I want us to unpack here uh, are what the Trump administration's objectives really appear to be as they've come in to this second term. And one of their first objectives has been to rein in federal spending. And I think most people would agree that that is a necessary objective on the part of any administration. Uh, and so the way that they've gone about it in partnership with Elon Musk and the Doge group is to find a way to reduce excessive government expenditures. Um, but the reality is that the significant amount of government spending that we've done over the last few years has been one of the main economic drivers for the US economy relative to the rest of the world. And so as we bring that spending down, it's likely to have some negative economic impacts. And so we'll go over here to the screen. So this is from the Atlanta Fed. They're a GDP Now model, which is a forecasting mechanism for where they think that economic growth will come in. And we see that for Q1 of this year, they're expecting that GDP growth for the quarter annualized is going to be almost a decline of 3%. Uh, and so as we would continue to grapple with this reduction in fiscal spending, we very easily could find ourselves in a recession um, simply by virtue of the fact that we are removing one of the critical drivers of economic growth. Uh, Now, Chad, that helps, that slowdown in economic growth. It is actually helping to uh, it's actually helping to achieve one of their other objectives, which is to lower interest rates. And
Hmm.
whether it's through the economy slowing down because of less fiscal spending or concern around these tariffs, we've seen interest rates take a significant nosedive here this week as well.
Yeah, certainly. And, that's been a continuation of what has been the trend for the year. You look at the 10-year Treasury yield, it was up, over 475 as we started the year this year, and,
Yep.
kind of gradually working its way down. And now in the last couple of weeks has further declined down to below 4% finally, which is significant in terms of that objective or that would hoped for outcome from the Trump administration of getting interest rates, longer term interest rates or intermediate term rates lower. So that's progress there. Now, of course, it's happening in part because of concerns in the bond market and the markets in general about the slowing economy and the potential for recession, which is increasing now. So
Yeah, but as it relates to the Trump administration's objectives to bring down interest rates, and I know we've talked about this in our podcast and our monthly videos, and some of our other commentaries that we've written, that the amount of government debt that exists right now, and a lot of it is coming due this year, and it's
mhm.
going to have to get refinanced. And as you mentioned, at the beginning of this year, the yield on the 10-year US Treasury was around 4.8%. And so it has come down markedly. This morning, it's at 3.92,
Yep.
3.91. So it's come down a lot. That will be a benefit to the US Treasury as they go to refinance some of this debt. It's not going to be at the elevated levels that it was at the beginning of this year. I think they like to see it come down even further. But the positive for lower interest rates should also trickle through the economy, bring mortgage rates down, I know is another objective that they have. And so that's something that can be beneficial to consumers. Um, but it also is certainly signifying concerns around economic growth or the lack thereof. And that's one of the reasons that we're seeing these interest rates come down. We're seeing them come down on the front end of the curve as well. Um, the yield on the 12-month T-bill is around 3.75 this morning. The 3-year note is around 3.5.
Mm-hmm.
And so I think one of the things we could look through to here uh, is that the market is getting in front of or anticipating we've got a couple more Fed cuts coming. May not be a lot. Now, if we see these rates continue to come down further, maybe they're starting to price in the fact that the Fed's going to have to lower rates a number of more times.
Right.
But that's probably an expectation that we should have is that the Fed is probably going to be lowering rates maybe another 0.5% to 0.75% in the next 12 to 18 months.
Yep. Well, and with that, let's maybe pivot over to talking about how all of these developments are kind of translating into allocation of capital in client portfolios, and of course, in the way that the environment is shifting, but in particular, how we at Reveille are adjusting to this environment accordingly. And it's an interesting development that we've been highlighting throughout the year this year, and also been kind of cautioning even prior to coming into this year that we would anticipate seeing a shift in the market dynamics of leadership among U.S. Stocks in general, U.S. large cap growth stocks in particular, and then the opportunities that presents for looking elsewhere outside of just the U.S. stock market and these other diversified asset classes that have actually now been benefiting from some rotation that's going on. So let's kind of talk about what we're seeing there and how we're adjusting accordingly.
Yeah. Well, so to that point, we discussed a lot last year. I mean, even from the middle of last year, how the valuations in large cap U.S. stocks, particularly the growth stocks, so the NASDAQ, those valuations were really high. And when you have high valuations, your expectation should be that returns are going to be lower in the future. And I know that's hard for people to wrap their head around when things seem like the getting is so good, and why would it change? But I know as you've been highlighting in our weekly trend updates, the trend for a lot of U.S. stocks has rolled over. Really since late February, early March, that trend has been moving down. We see it here with the NASDAQ. We see the same thing here with the S&P. And so, to not expect markets to move lower when, as far as we're concerned here at Reveille, we are in a downtrend.
Yep.
Markets that are in downtrends, they move lower.
Right.
And whatever the reason or the rationale is, we're never going to know. And of course, we have no idea how far down this downtrend could go. It could go down a lot longer than we think. It may be more brief than we think. I know there are a lot of investment strategists coming on the TV right now, and they're trying to assuage investors that the concerns in the market right now and the sell-off that we're seeing in the market right now is really related to these tariffs, and it can be short-lived because these things could get negotiated and then we could rebound very quickly. And perhaps that is a possibility, but right now the direction of the U.S. stock market really, I mean, across the board, we looked at the NASDAQ, we've looked at the S&P right here, if we look at the Dow Jones Industrial Average, it's going to look very similar. If we look at the small cap U.S. stock index, the Russell 2000, we're going to see again a very similar picture. This one maybe even a little more drastic. Now, ironically, we don't see that quite as much in the international space, right? There's some pullback here within the international space, but we're still, for right now, we are in uptrends in the international markets.
Right. Yeah, and there's a lot of focus this week since we're recording on Friday, and it's the end of what's been a pretty interesting week with a lot of volatility, especially to the downside in the markets, driven by the developments around the Trump policy and the tariff policies that have been announced and shifting even further and even more extreme than what had been anticipated or being priced into the markets. And so in the midst of this volatility this week, there's a lot of anxiety that's and even as we're speaking right now, the futures are indicating down another 1,000 on the Dow. But what's important to highlight is coming into this week, we were already in established downtrends in the U.S. markets. And for us at Reveille, we, like as you just mentioned, we've been highlighting this development now since the beginning of March. And so that leads us to systematically reduce exposure to those areas that have now shifted into downtrends and begin to raise more cash levels and get more defensive and yet stay more focused on those areas that are still remaining in uptrends, like, for example, the bond market, which is benefiting from rates coming down, commodities that have continued to improve, and then international stocks. And so, I think it's important for us to highlight for our clients, but also for everybody else out there, the importance of diversification, but also the importance of adapting to the changing trends that are unfolding in the markets and being aware of risk. And for right now, the order of the day is a bit more of a mindset toward defense and preservation of capital.
Yeah, no, and I love the comment about managing risk, because for a number of years, investors have become much more oblivious, I would say, to the amount of risk that they're taking, or they've just been kind of damn the torpedoes, full speed ahead, because the markets were moving up and they thought, well, how much risk can there be when the markets are moving higher? Well, they're starting to maybe understand that, yeah, there is risk in this market, and that our belief is that our core responsibility is to help clients manage risk. And sometimes what that means is when markets enter downtrends, that maybe that's not a market that they need to be fully invested in anymore.
Yes, certainly.
And that isn't a narrative that gets parroted very often on the CNBCs and Bloombergs of the world, and with most financial advisors. That I already saw a headline this morning after the fallout yesterday, where the Dow's down 1,700 points, that a lot of advisors are trying to tell their clients what we would expect. Hang in there and ride it out. And again, we have no idea exactly where this thing is going, but the only thing that we know is that the general trend for U.S. stocks right now is lower, and we should anticipate that trend remains in place and that stocks continue to ratchet their way down. Not to say that there won't be some good days, and who knows, maybe the market has already found a bottom, but that's probably less likely than many are hoping.
Yep.
So
Certainly. Well, Thanks for taking that time, Stephen, for us to talk through this and again, just bring to light the changing environment and the importance of adapting accordingly, and with a keen eye toward risk management.
Absolutely. All right, Chad. Well, thanks for jumping on here this morning. Everybody stay well out there, and we will talk to you soon.